Global equity markets rallied strongly today, buoyed by renewed optimism surrounding US-Europe trade negotiations and easing geopolitical risk, sending both the S&P 500 and Nasdaq to fresh records. Investor sentiment pivoted away from late-week reticence toward strategic optimism. Retail speculation surged in meme stocks as valuations heated up across select small-cap names. Technology and AI leaders continued outperforming while laggards consolidated. Institutional sentiment remained cautious but opportunistic, preparing for next week's key central bank events. Cryptocurrency markets experienced focused volatility, with Bitcoin slipping below $116,000, triggering long liquidation sweeps and driving short-term volatility across derivatives markets. Ethereum retreated toward $3,600, falling roughly 1.6%, while XRP and Solana saw declines near 5 to 6% amid profit-taking. Notably, the mispricing attracted large-scale accumulation in ETH and BNB, signaling investor confidence at support zones. Daily trading volumes spiked nearly 40% as volatility heightened. These moves underscore the ongoing structural resilience beneath headline selling pressure.
A wave of institutional crypto treasury initiatives dominated headlines, with 98 public firms raising over $43 billion to purchase digital assets directly. Companies like Bitmine and entertainment firms made headlines with strategic crypto holdings announcements. This trend underscores corporate executives' embrace of digital assets as capital strategy tools. Critics warn of overvaluation risk, especially if token prices retrace sharply. However, institutional capital deployment continues accelerating despite skepticism. Stablecoin regulation gains momentum as financial entities such as Anchorage Digital and others prepare issuance platforms in compliance with the newly enacted Genius Act. Banks worldwide, including in Nigeria and South Korea, filed trademark applications for dollar and yen-backed stablecoins. This regulatory clarity is fostering broader institutional adoption across the industry. Analysts expect stablecoin aggregates to grow exponentially over the next quarter. Policy progress is catalyzing new revenue streams for fintech and digital payment infrastructure firms.
The Clarity Act, which designates many cryptocurrencies as commodities rather than securities, advanced through House leadership layers this week, emphasizing legal certainty. Senator Moreno and other crypto-aligned lawmakers pushed the measure forward to redefine regulatory boundaries. Passage would reduce operational risk for exchanges and token platforms under SEC scrutiny. Market participants welcome potential classification clarity supporting asset accessibility. The pending legislation forms part of the broader market structure narrative for cryptocurrencies. On-chain data revealed Galaxy Digital moved 3,420 BTC, worth nearly $395 million, onto exchanges within minutes, triggering speculation about short-term sell pressure or rebalancing strategy. Meanwhile, whale wallets accumulated Ethereum sharply, especially around the $3,700 price level. CryptoQuant reports accelerated profit-taking and hedge-driven positioning across DeFi protocols. Realized net profit-loss charts suggest a profit peak approaching stall zones. This on-chain activity confirms that key players remain engaged despite volatility. Major U.S. indexes recorded measurable gains. The S&P 500 rose approximately 0.4%, while the Nasdaq increased by 0.2%, its ninth record close in 10 sessions. The Dow Jones saw modest growth despite sector rotation. Broad market traction was supported by continued strength in AI and cloud names. Treasury yields climbed slightly from recent lows, reflecting some inflation pressure. VIX volatility remained benign, confirming subdued panic despite stretched valuations. Retail behavior reflected renewed froth. Meme stock mania resurged as small-cap equities rallied on Reddit-fueled pumping. Coals, GoPro and Krispy Kreme stocks saw intraday spikes reminiscent of earlier speculative waves. Margin debt now exceeds $1 trillion, amplifying systemic leverage risk in the retail segment. ETF flows skewed towards safer sectors even as retail proxies soared. This bifurcation highlights divergence between cautious institutional positioning and retail enthusiasm.
Sovereign bond markets remained stable but watchful. Japanese demand supported U.S. Treasury auctions, limiting volatility in longer-dated notes. A large $173 billion Treasury note auction loomed ahead, raising concerns about bond demand under extended equity valuations. Mortgage rates remained near mid-6% levels, weighing on housing affordability. Credit spreads persisted within normal ranges, despite broader risk buildup. Liquidity across European and American bond markets remained orderly. Trade and fiscal policy interplay raised concerns. U.S.-China talks scheduled in Stockholm aim to extend tariff deadlines, while U.S.-EU negotiations may encode new trade frameworks. IMF issued warnings on UK fiscal rigidity amid rising public debt and shifting policy tone. NatWest's strong profit results contrast against looming pressure in UK retail and inflation dynamics. The pound weakened to three-month lows, reinforcing cross-border currency risk. Investors weighed trade optimism against persistent macro uncertainty. Corporate earnings diverged across sectors. Intel shares fell nearly 6% on a surprise loss and workforce reduction announcement. Decker's Outdoor, in contrast, soared over 12% following strong results from Hoka and UGG brands. Newmont, the gold miner, reported stellar profits and launched a $3 billion share buyback program. Alphabet and AI-focused firms continued outperforming. This portfolio mix demonstrates selective focus on high-margin, growth-linked names.
Emerging Asian markets delivered mixed signals. Japanese equities benefited from trade optimism, but declined later on domestic political risk. Indian markets gained on improved export sentiments, tied to a bilateral pact with the UK. Chinese digital currency stocks rallied, reflecting policy ease and renewed technological growth. Korean exchanges responded to tech export constraint concerns. Across EM, investor behavior remains calibrated regionally based on specific catalyst tracks. Commodity markets showed nuanced trends. Gold futures declined modestly amid reduced safe haven demand. Oil dipped slightly amid revised global supply signals from Venezuela, while copper and nickel rose modestly on optimism tied to trade flows. Sector-specific ETFs in metals and agriculture attracted renewed interest. Commodity exposure remained strategic rather than speculative. Markets indicate measured hedging rather than aggressive asset rotation. Currency markets reflected stability with subtle shifts. The US dollar maintained strength against major currencies amid safe haven flows and weaker pound sentiment. The yen gained on local bond yield adjustments. Emerging market currencies moved softly in sync with equity moves. Cross-currency correlations remained within recent ranges. FX remained driven by fundamentals rather than shock-based swings.
AI and tech remain central to growth narratives, as Microsoft, Meta, Amazon, and Apple prepare to release earnings. AI spend hikes and monetization strategies remain core investor focus. Buy-side models now heavily weight AI exposure across valuations. Tech outperformers offset slower traditional firms. Market anticipation builds toward earnings catalysts slated next week. ETF inflows accelerated into thematic sectors, including crypto-linked funds, healthcare, metals, and AI innovation. U.S. ETF assets now exceed $11.6 trillion, underscoring structural market depth. Active managers pivot toward income-yielding and volatility hedge products. Thematic ETFs are attracting risk capital despite broader equity momentum. These inflows further reflect investor segmentation and tactical deployment of capital. Venture capital activity remains subdued amid macro caution, with smaller deal sizes and tighter valuations in fintech, biotech, and AI startups.
institutional caution reigns, emphasizing cash flow and path to profitability rather than growth at all costs. Funding cycles elongated, while capital allocators favored deferred deployment. Company valuations are adjusted for risk rather than narrative. The VC freeze aligns with cautious capital distribution strategies.
Real estate markets continued showing moderation. New housing starts declined, and mortgage applications slowed due to elevated borrowing rates. Inventory remained tight in select metros, maintaining price resilience. Construction firms adopted conservative development plans. REIT performance diverged by sector, with industrial and healthcare properties outperforming residential. The real estate landscape reflects adaptation rather than shift into crisis. Investor sentiment metrics indicate controlled optimism, with volatility indices remaining subdued despite stretched valuations. Technical support zones persisted at $115,000 for Bitcoin and S&P 6400. Market psychology shifted from fear-driven responses towards selective engagement strategies. Risk management tools such as options hedging saw increased usage. Overall sentiment suggests calm accumulation phases amidst valuation risk. In closing, today's $43 billion crypto capital influx, record equity highs, rising margin debt, and trade progress reflect strategic market positioning ahead of key economic data and policy events. Institutional reallocations into AI, crypto treasury holdings, and high-quality equities are notable. With Fed commentary, tariff deadlines, and major tech earnings ahead, investors prepare to act decisively. This environment rewards strategic discipline over emotional response, and insight becomes opportunity.